The market evidently has so far only wanted to reward one Canadian bank for their first quarter earnings results. And unfortunately for National Bank, it wasn't them. The company saw their stock fall over 5% following the release of their first quarter results for 2025. And similar to Scotiabank, this deterioration in the stock price comes despite the company surpassing analyst estimates. So, what exactly went wrong in the eyes of investors? Guys, we're talking National Bank. We're talking Q1 earnings. I know all the banks in Canada are actually a quarter ahead, so technically it's calendar year Q4. But we're talking National Bank. We're talking Q1 earnings. Let's dive in. National Bank in the first quarter of 2025 reported top-line revenue of $3.2 billion, a 70% increase on a year-over-year basis from the $2.7 billion in revenue recorded in Q1 of 2024, with revenue notably improving across all business segments. Consensus estimates, meanwhile, had called for revenue of $3 billion, which National Bank handily beat. Revenue improved for both net interest income, which grew from $751 million last year to $972 million in the first quarter of 2025, as well as non-interest income, which improved from $2 billion to $2.2. Non-interest expenses, however, also improved, jumping from $1.4 billion to $1.6, leading to less substantial growth in net income than what was exhibited by revenue. Net income grew from $922 million, or $2.59 per share, to $997 million, or $2.78 per share, an 8% improvement. On an adjusted basis, net income grew from $922 million, or $2.59 per share, to $1.05 billion, or $2.93 per share, with adjustments including the exclusion of expenses related to the acquisition of Canadian Western Bank. Consensus estimates had called for a much more conservative $2.65 per share, leading to National Bank again beating guidance. National Bank ended the quarter with a Common Equity Tier 1 capital ratio of 13.6%, which was down from 13.7% in the year-ago period. Its leverage ratio also declined slightly from 4.4% to 4.3%. The bank ended the quarter by declaring a dividend of $1.14 per share for the quarter, which was flat versus the fourth quarter. Let's move on to the segments. National Bank currently operates out of 4 separate segments, and much like their Big Six peers, personal and commercial is the largest. PNC in the first quarter saw total revenues of $1.2 billion, which was basically flat on a year-over-year basis, increasing by just $50 million on an adjusted basis. Net income for the segment, however, was down as a result of a large increase in provisions for credit losses, with net income declining from $339 million to $290 million. Broken down further, personal lending is said to have shown growth of 4%, while commercial lending grew by 13%. National Bank's wealth management segment also saw revenues grow from $660 million to $776 million on a year-over-year basis in Q1. Net income also improved, climbing from $196 million to $242 million. Financial markets, meanwhile, saw revenues go from $755 million to $907 million, but this revenue improvement was partially offset by higher credit loss provisions and non-interest expenses. Net income, however, still improved, moving from $308 million to $417 million. Finally, U.S. Specialty Finance and International saw revenue improve from $326 million to $405 million, while net income improved from $150 million to $183 million, with the segment again also exhibiting an increase in credit loss provisions, which were attributed to Credigy and ABA Bank. An increase in net losses, however, was seen in the other segment, which saw losses of $71 million on an adjusted basis last year grow to losses of $82 million on an adjusted basis this year. All right, time for our favorite aspect of bank earnings, the credit losses. Across all lines of business, provisions for credit losses increased rather substantially. Provisions increased by 22% on a year-over-year basis, jumping from $1.3 billion to $1.5 billion, which is said to be due to good performance in all of the business segments. The provisions were largely attributed to personal and commercial, which took on $162 million in additional provisions during the quarter. U.S. Specialty Finance and International was the second largest contributor at $51 million, followed by Financial Markets at $36 million, Wealth Management at $2 million, and Other at $3 million. Gross impaired loans hit $2 billion, increasing by 11 basis points to 0.79%. The largest segment impacting gross impaired loans is U.S. Specialty Finance and International, with ABA Bank providing a substantial portion of the impairments. The segment accounts for $791 million of the $2 billion in impairments. National Bank's retail portfolio, meanwhile, continues to see increasing rates of loan delinquency. However, it should be noted that mortgage delinquencies declined by a single basis point, going against the trend seen at the other big six banks. Finally, we can't talk about National Bank without mentioning the recent closing of their purchase of Canadian Western Bank. The transaction, initially announced in June of 2024, saw National Bank purchase the remainder of CWB that it didn't own at an implied valuation of $7.7 billion. Prior to that announcement, National Bank had held a 5.9% interest. The purchase came in the format of a share exchange for CWB shareholders, with Canadian Western shareholders receiving 0.45 common shares of National Bank for every share of Canadian Western Bank held. A total of 50.3 million shares were issued in connection with the transaction, which were valued at $5.3 billion. As part of the purchase, National also spent $1.4 billion on the settlement of pre-existing relationships and $100 million on the issuance of replacement share-based payment awards, among other expenses. All right, folks, let's wrap it up. While National Bank managed to exceed consensus estimates for the first quarter, the concern here by and large appears to be the growing provisions for credit losses, especially given the current macro environment conditions, which are filled with plenty of uncertainty. We've got Donald Trump talking about his tariffs, a housing market that is out of control, Canadians leading the G7 in household debt per capita, and in the backdrop of a declining market. Look, guys, I can't help but think that some of these banks are going to be crying to the Canadian taxpayer to bail them out, despite all of the mortgage insurance they get. Because if Donald Trump decides to move forward with these tariffs, all of these banks are going to have a really, really rough couple of years ahead of them. All right, everybody, thanks for watching. If you enjoyed this video, please smash that like button, subscribe, and ring that notification bell. Guys, as always, if there's stories you want us to cover, please let us know in the comment section. Thanks for watching, everyone.